$29.24. We are going to then consequently sell the $30 covered call, giving somebody else the right to buy the stock from us at $30 a share. The premium on this is going to be $1.20, and the days till expiration is 42. So we have 42, and we usually do this calendar days, by the way. 42, that's 6 weeks, right? Is that what, seven days a week times 6? 6 weeks till expiration. So we're looking at a 6-week trade. The price at expiration is $29.24. Now let's stop there. That's assuming the stock stays flat. Let's think. If we own the stock at $29.24, we're giving somebody else the right to buy the stock from us at $30 a share. They're assuming that it's going to go higher than 30. And the stock at expiration is $29.24. Would they buy the stock from us at 30 if they can go on the street and buy the stock from us at $29.24? Class, are they going to buy it? Yes or no? No. So that option is actually going to expire worthless on the other person. Now let's think about this. Now that time decay is working for us. Open up your mind. Paradigm shift. Literally every month you can make money doing covered calls. Every single month. 5-10% a month. That's the numbers we're talking about. Shoot for about 5%. Okay? So in this example right over here, we see there's our covered call calculator. We click the little calculate button right over here, and the numbers play out. So total out, if you were to do this transaction, you multiply the 400 shares by the $29.24. We see that it's $11,696. The total income from the sold call option is going to be $480. That means our net investment is $11,216. We're not called out. You see here, not called out. Therefore, we just keep the $480, and that's about a 4% rate of return. Now, again, I may be new to this, but if we've got 4% rate of return on a stock that trades flat, multiply that by 12 months. I could be wrong, but is that about 48%? Class, yes or no? Is that pretty good? Cut it in half. Is that okay? 24%. Is that good? I don't know. Fast forward our conversations. Fast forward your learning curve 10 years from now. I mean, again, you're just learning this right now. I understand you gentlemen and ladies were new. Fine. I was new at one point. Fast forward. Begin with the end in mind. Where could you be with this in 10 years? Now you can understand why people are coming back to us for more education and staying with our website and watching and reading our market commentary 3 days a week, because we're doing the same thing and we're sharing our success with you. All right? So again, that's our basic transaction. Now let's go ahead. If we run down here, the price expiration is $29.24. All right? And there's our break even. If you'll see right over here, our break even is $28.04. Why is that? The price at expiration is $29.24, and we are selling a $1.20 premium. If you take $29.24, subtract $1.20, you'll find our break even is $28.04. Now, your instructor probably did this for you in class, but I want to just kind of reiterate this here for you. If you are a stock owner, you would buy the stock for $29.24. That's your cost basis. If you are like me and like a lot of our alumni students and the hundreds and thousands that we've retired, you do a covered call. That means you buy it for $29.24 or you own it for $29.24. You sell a covered call on it. You get in a dollar premium. Your cost basis is now $28.04. $28.04 or $29.24. Which would you rather have as far as your cost basis? The lower cost basis, right? Therefore, ladies and gentlemen, I want to make sure this is clear. Doing a covered call is more conservative than owning stock outright because your cost basis is lower. That's the way it is. So let me think. Part of your job is to reduce risk. Consequently, covered calls will fit like a 5-fingered glove. All right? So that's our price at expiration, and that's what we're talking about as far as our results. Now, what happens if the price at expiration is actually $30 a share or higher? Well, again, let's think. We own the stock at $29.24. We sell a $30 covered call, which means that somebody has the right to buy the stock from us at $30. At expiration, the price at expiration is $30. Well, in that circumstance, they will buy the stock out from us. So not only will we make the $4.80, but we'll also make the small, 76 cents that we get in the appreciation of the stock. In that circumstance, not a big deal, but our 4.1% moves to 6.7% in 6 weeks. That's 6 weeks, okay? a very respectable rate of return. Now, again, not going to knock your socks off. Some of you folks are bored at these rates of return. That's fine. That's part of the reason why we use the long call and long puts. But to make sure we understand where we're at is long term, you may not be buying long calls and long puts all the time. You may have a nice size portfolio. I hope this is the case. Your children will as well. And then every month we'll write covered calls on that. Just think about that, making maybe 5 to 10% per month. Well, let's think. Do you need millions and millions and millions to retire on if you're making 5% a month or 10% a month on your money? No, not really. You need an education. I'm glad you're here. But you don't need millions and millions and millions because we all have the same expenses, right? We all have food and fuel and insurance and, the basics of life, right? So just think about that. Again, begin with the end in mind. Whatever business you're in, make sure you have an exit strategy for that business. Monitoring that position. As long as the stock stays below your option strike price and above your stop loss, do nothing. You're good to go. Let time work on your behalf. Just think about it. Wake up in the morning and think, because there's another day that happened and you sold an option, you woke up, and as soon as you woke up, you made money. Would you maybe approach the day a little bit differently? All you need to do, as soon as the alarm clock rang, you think, wow, as soon as the alarm clock rang, I just made some money. Would you have a different aspect? Would you have maybe a different perspective? Maybe you take more naps. I don't know. So you could hear the alarm clock more often. I don't know, okay? But just think, time needs to work on your behalf, okay? If the stock rises above the strike price and you do not want to sell the stock, you can buy the calls back to close out the trade. Now let me reiterate that, and let me use my real estate example. All right? Let's say we have the real estate. Remember when we bought an option to buy somebody else's house? We spent $5,000 to control somebody's house at $100,000. And then we saw that the house, for whatever reason, went up in value. All right, it was worth like $150,000 because the builder or the developer was coming by and offering more money, whatever the case is. Well, the owner of the house would legally be obligated to sell the house to the gentleman or the person who owned the lease option. But wait a second. Is it possible for him to go to the person who has the lease option and say, you know what, I don't like this deal that we struck up anymore. Here's your money back. Could he do that? He absolutely could. And so it's called buying your call back or buying your lease option back. Once that obligation's been removed, then the person owns the stock or house, they're free to do whatever they want. Let me go back to my stock example. You have a $30 stock. You sell, let's say, a $35 call on the stock for, $2. Let's use round numbers. The stock has fantastic news. The stock goes up to 32, 33, 34. Next day it goes 35, 36, 37, and it's doing it on heavy volume. Class, that means that you're going to have to sell your stock at what price? 35. And you are not going to participate in any of the appreciation above 35. What could you do? You could then go ahead, call the market maker back, or just do it all online and say, that option I sold you for $2? I want to buy it back. Let's say the stock's now 37. They say, well, that option, that's now $4. And you say, that's okay. So you actually sold it to the market maker for $2, and you bought it back from them from $4. Did you just lose money? You sure did. You lost $2. But then, wait a second, your stock went from 30 to 37. Did you make it up in the stock appreciation, okay? So remember, these are very easy to move in and out of. So if it's going against you, and what do I mean by going against you? Your forecast for a covered call mainly is neutral to slightly bullish. Going against you means one of two things. Of course, it goes way up or it tanks way down. Either way, you can get out. Again, how? You would go back to the market maker, call them up and say, hey, I'll release my obligation, let me buy that obligation back, and then you're free to sell the stock, okay? If the stock drops below your stop loss, buy back the calls and then sell your stock to close out the trade. The same thing I just explained. Watch the stochastics and MACD indicators to time your plays. So let's go over closing it out. Can happen at any time, as I've kind of mentioned, but usually only on expiration day. Any price equal to or over the strike price of the call option requires no follow-up action. Everything happens automatically in your account. Now, depending on where you're at and the size of your account and the customer service level of your brokerage house, many people will go ahead and use this experience of when you're called out of a stock to go ahead and use that to actually call you up on Monday morning. It's the Monday following expiration, and they will say, hey, this is what it sounds like in one of my brokers. Hey, Michael, let me let you know of all your assignments. I don't know why they use that word. Assignments, okay. And they say, oh, you did a covered call on this, you did a covered call on this, we took this stock from you, this is a profitable trade, great job, profitable trade, and they're kind of getting to know me. They say, hey, wow, you're pretty good at this covered call thing. You've made 6, 7, 10% a month on your money. This is pretty interesting. So the next time I call them up, they kind of know me a little bit, right? This could be a live broker too. You can say, hey, listen, I know I can develop some rapport with them. As you progress to the higher levels, even on your online brokers, you'll get special status. So it's platinum status, or I used to have with one broker, I had Starfleet Commander status. No, I'm just kidding. I made that up. But you have really good status, and so they go, oh, wow, Starfleet Commander. What can we do here for you? And I said, just give it as much power as you can. I don't know. Whatever you want to do, but develop rapport with these people. Okay? I mean, again, the abundance mentality. We're all in this together. Share your trades. Share this with your broker too. And I say that for a reason. Then a lot of these brokers, they don't even have your skill set. There we're taught, how did they become a broker? They passed it, maybe a Series 6, maybe a Series 7, maybe a 63, whatever they have, they learned to pass a test. They may not have this skill set. They certainly may not have our website, so they don't understand some of the things that we're talking about. No big deal, don't fault them. Their job is to make money, make profit, just like your job, all right? So you may want to educate them a little bit too. Not called out. You are not called out. Any price below the strike price of the call option on expiration day. Keep the stock, which is valued at the current market price, and you're free to sell another call for the next month. So let me get this straight. If you own the stock and you sell a covered call and you're not called out, you just keep the money. Next month, do it again. Next month, do it again. Do it again, do it again, do it again. Welcome to the money machine. That's literally what your account should be, a cash flow machine. Get out. Uh-oh. We're in trouble. Some bad news had happened. Here's a key. This is what bad news looks like. You pull up CNBC or your local CNN, whatever it is, and you see that the CEO of the company is walking out of the headquarters like this. Okay? That's bad news. Okay? We think the stock is going to go down. He's in trouble, right? Mental stop on a stock at 3 to 5% below support. Buy back the call option to remove the obligation and then sell the stock. That's exactly what I said. Let me reiterate that. If you have a bad situation, we need to remove our obligation by buying back our call option, and then we're free to go ahead and sell our stock. Now, after you learn a little bit more about advanced options, you can learn you don't necessarily need to do it in that order. That's covered in our advanced options class. Those of you for right now who are learning about this, you do it in that order. You first buy back the call option to remove the obligation, and then you sell the stock. So we use covered calls on stocks you own to unlock the earning power of your portfolio. Ideally, use calls 1 to 3 months from expiration. Avoid selling your stock by closing out the covered call play prior to expiration day. Let me say that again. Avoid selling your stock by closing out the covered call play prior to expiration day. Again, stock has really fantastic news. Go ahead, buy back that covered call, and let your stock run. Remember, let me do one more bullet point, and let me come back to that. Use stochastics indicator to decide between growth or income. All that generally means is we're generally looking to buy the stock on the green arrow of stochastics, and when we notice that it may be tipping over a little bit, that's the time that we may do the covered call. Several times to do a covered call. We can do them both at the same time. Buy the stock and do the covered call. That's called a buy right. Again, this is covered by your coaches. We can also use this for income. We can literally, this is what one of our students did. I thought this was very savvy. I do the same thing when I pay more attention to it. Sometimes I don't work this hard, but they have a great amount of stock, not a great amount, but a nice share of stock. And then they own the stock. They sell the covered call. All right? Stock goes up, down, whatever. And then in the middle of the month, the stock goes down. They buy the call back, even before expiration. And then the stock goes up, hits resistance. They sell the same call again. And then the stock goes down and they buy it back. So, again, a little bit more advanced concepts, but keep in mind, you own the stock anyway. You can sell the call. Let's say, in fact, this happened to me last month. In fact, I think I'm out of that trade right now. I have to check my brokerage. I think I am. I own the stock at about $20 a share. The stock went up to $23. 15%. Is that good? That's a good rate of return. I could sell it right there and we're good to go. but I bought the stock for the purpose of writing a covered call. So then I sold a call option, and then actually the stock announced some earnings that were a little bit less than favorable, and the stock starts going down. Down, 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 down. Well, the stock actually, this is not exactly what happened, but let me keep the numbers round, is if that stock were to, let's say the stock were at $23 a share, I could sell any option. I could sell the 20, the 22.50, or the 25. What I did is I actually sold the 22.50. So I bought the stock at 20, went up to 23, and I sold the 22.50, giving somebody the right to buy the stock for me at 22.50. Well, the stock goes down, 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 down. Guess what happens to the call premium? It goes down, 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 down. I sold it for about $3, bought it back for about 80 cents. Did I just make money? Yep. Made money, sold my stock for a profit too, washed my hands of the trade, had fun. Okay, so I just hedged, just a more deft, more savvy way to go ahead and work your investments when you understand time decay and covered calls. Now, let's go back here. How do you find stocks? Now, the stocks in your portfolio may not be the best stocks to write covered calls on, so how do you find stocks for the covered call trade? I see a lot of you folks, and I've seen the alumni students, are very, very attracted to covered calls, so let's use our system to do that. First of all, you must like the stock. It must have strong fundamentals and technicals. The stock must have options, of course, and in the $10 to $50 price range, we found that works best. But any optionable stock will do, and a minimum of 5% monthly return. At first, if you're reading this or you're here for the first time, that may seem a bit of a stretch. Stay with us. At the end of the day, at the end of your coaching, you'll realize that's not necessarily a no-brainer, but that's very, very doable. Very, very doable. Why the $10 to $50 strike price? The reason why we use that is just the mathematics work out the best. I would rather sell using round numbers, I would rather sell a $3 option on a $30 stock than a $5 option on a $100 stock. Just the mathematics, the metrics work better when we stay in between the $10 to the $50 price range. Well, go on our website right over here, strategies page, and go down to the left-hand side where we see the covered calls. We have a couple different areas there. We have the screenings and commentary and the pre-built and custom searches. Well, let's first click on the pre-built screens. Here we see stocks. In fact, let's take a look at this graph. We see here's the stock symbols. There's the stock symbols right there. Genzymes, prepaid legal services, etc. They're the great stocks, okay? And these are the calls to sell. There's right over here. The price. And it goes, the stock, the strike, etc. But when you do this, it talks about these are really high quality stocks, and if you sell these covered calls, you'll produce a very, very profitable rate of return. This is simply a beginning part of your research. This is not the be-all and end-all. This is the beginning part of your research. You don't buy all the stocks on that list. You are going to have to own those stocks for at least 30 days. If you do it at the beginning of the month. Therefore, it has to go through our phase 1, phase 2, the whole 9 yards. Also, another place to start, not as specific as the pre-built search not as specific as the previous screen, is the pre-built and custom search. Well, right over here, let me go back to that.